Hey everybody that's in the meeting. My name is Zhao. I'm an analyst at Invest Detroit Ventures, and really I'm one of the people on the investment team that kind of leads the sourcing and leading the diligence process for new investments. So it's really nice to talk to everybody. Invest Detroit Ventures is one of the most active early stage funders in the state of Michigan. So we have a geographic focus, and we invest in high growth, high potential startups that are tech enabled in some ways. So since our inception, we have invested in over 140 companies with 54% of our founders being diverse. And we have leveraged over 800 million in additional funding as well. So we invest out of 3 different funds, the First Capital Fund, the Detroit Innovate Fund, and the First Step Fund. And the First Capital Fund is our most active fund, and it's an evergreen fund. So what that means is all of our investments that go out of the First Capital Fund, the returns go back in. So we're hoping to create an investment vehicle to really support all of the early stage startups in the region with that first institutional check. We also operate 2 other funds. Detroit Innovate is a traditional for-profit venture capital fund. And the First Step Fund was a previous evergreen fund that kind of emerged into the First Capital Fund. To give you guys an idea of how many companies we invest in and how many different sectors, you can take a look here. All of these companies are based in Michigan. And if you're interested in learning more, please go to investdetroit.vc. So you can see software, we do life science. So it's all across the board. But diving into the kind of the conversation today, what I wanted to focus on and want to talk about is what story does a venture capitalist want to hear? And it's not an easy question by any means. So I do want to start off by kind of posing a hypothetical question. Okay? If you're someone that has $100,000 to put into a company, what do you want that person who's seeking investment from you? What do you want them to say? Do you want someone that comes up to you and says, "Hey, I'm going to run out of money in a month. I need some money in order to keep my business afloat"? Are you going to give them that $100,000? Because you do have a high chance of potentially losing it? Or do you want someone maybe to come in and say, "Hey, I don't need your money, but if you give me some money, I can achieve X, Y, and Z milestones, and then I can make your money into more money"? So, it's not an easy thing to decide on, and there's a lot of factors to evaluate. And what you'll notice in terms of venture capital as an industry is that most companies don't return. 0.4% ever return more than 50 times. So all of the stories that you see on the news, you see, Snowflake just IPO'd in the largest software IPO ever. Well, most companies can't do that. And so from a venture capitalist perspective, there's a heightened chance of risk and a lot to look at when we decide what type of company that we want to invest in. So once again, expectations are going to be pretty different per stage. So there's a startup stage, scale up stage, and kind of a scaler stage. And a good analogy I recently heard is if anybody has read Peter Thiel's From Zero to One, right? So that's a first step to kind of building a startup. There's also a 1 to 10, and then a 10 to 1,000. And there are going to be investors in each stage, and they're going to look at very different things in order to reduce their risk. But today I'm going to kind of focus on the startup stage, the very first stage of 0 to 1, and how do you talk to an investor when you don't have too much, but kind of enough to entice someone to believe in you and potentially make an investment. So here's the kind of the traditional business model canvas that the classes teach you, right? You have value proposition, customer relationships, customers, revenue, ... Today I'll cover some of these, but what really I want to drive home is that you're the person. If you're the entrepreneur, you're the person controlling the narrative. And by that, you should have different presentations for different people. And you should really research kind of the investors, potentially the customers that you're pitching to. So let's say you're pitching to early stage investor that specifically focuses on the Internet of Things, and you are not selling an Internet of Things product. So that conversation might not be the right conversation for you to have. But knowing your investor and knowing who you're talking to kind of, informs what narrative you want to tell. So today I want to talk about 7 different things, and I'll try to go through these through examples that a venture capitalist want to see and look for. And I will also talk about some common mistakes entrepreneurs make when diving into these 7 different things. And then we'll end off, hopefully, with a discussion on, additional things that venture capitalists will look for, and also what you should not say in an investor meeting. So, let's dive in, right? So problem. Well, I think the problem is the most important thing. And sometimes it's very easily confused with the solution. When we think about something that makes, maybe our blood boil, or it's a pants on fire problem, we immediately go to the solution, right? Oh, I wish I had a vacuum cleaner. But that's not the problem. The problem is not your wish. The problem is that the floor is dirty. And that's a really core problem that I think startups sometimes struggle with. So here is kind of the overview of what you should do, right? So you have a 1-sentence, really simple statement. You want to use really easy language. You want to assume that the investor doesn't know anything about your business. And you shouldn't assume that they know anything at all, really, especially if it's a technical product. So once again, this presentation is more specifically for how you pitch to that investor. So this will be maybe a week or 2-week engagement where you're kind of talking to your investor through their initial kind of due diligence process. So this is something that you should absolutely have a clear idea on. What's your problem in very easy language? Customer tries something, there's a horrible pain, existing solutions are broken. You have to show that process. To provide an example, let's say you're in the machine learning space and you're doing IT operations, right, potentially. Many investors might not understand the complexities of the industry. So explaining that in a very easy way, it can take you a long way. So start off with an example here, a really good example. So 1 sentence here, this is a company called BGet. And you can kind of already tell what the company might do just from the problem slide. Managing projects is hard. 93% of B2B marketing professionals view content creation as a daily job. And then 70% say it's a challenge. This is really easy to understand. Even before I talk anything about this product, you can already have an idea of what it's going to be. And that's what a good problem slide can do. Right here, talking about the status quo and what exists today that's especially challenging is one of the core things. So manual processes, collaborating on shared documents is very hard. What do we do, right? So articulating both the broader problem statement and what exists today kind of helps the person that you're talking to understand what's coming. And so I think BGet did a really good job here. You can tell it's about managing content. It's going to be a content managing startup. So let me show you an example that's not very good. This company is called Go Fitcher. It's a medical tourism platform. Well, it is a 1-sentence statement, but it kind of feels offensive in a way. It also doesn't really tell me what you're doing. So you're going to give rich Chinese people first-class healthcare. Well, there's a lot of questions I'm going to be asking. So this is probably an example that you don't want to go after. It's easy, it's simple. I like the simplicity, but it's not. It's unclear and it's kind of offensive. So don't do that. But let's take a look at a successful startup mixed panel here. They have 2 slides for their problem. The first problem, let me tell you mixed panel what they do. Basically, they're your analytics platform. Really big company today. Most of the world will make decisions by guessing, or either be lucky or wrong. So that problem is way too vague. So if you only had that first slide, it's probably not enough. But if you talk about the second slide here, which is problem 2, it started to become a little bit more interesting, right? So companies on the mobile and web are measuring kind of these bullshit metrics. So it gets really hard, it gets really complicated. So what do we do then? Providing another example here, this is a company called Intercom, and also a huge company. So this is kind of a good slide, but also a lot of information. What they do well is they talk about the core problem. They talk about the status quo. But it's always good to, don't worry about the number of slides you use. Maybe divide this into multiple slides. So that kind of helps, drive home what the problem is. So once again, to summarize kind of what we talked about here, the problem is really important. You have to know your problem, and it can't be a solution. Which, that kind of takes us to what's a solution? Exactly.
Hey, Zhao, I hate to interrupt you. The internet is going in and out just a little bit.
Oh.
A little crackly. I was wondering if maybe moving locations would help, or if not, it's totally okay.
Okay, yeah, sorry about that.
No, all good, all good.
Let me try something here. Hold on. Yeah, sorry, everybody.
All good, no rush.
I am going to use my phone audio, so
okay.
Yeah, apologies.
All good. While we wait for anyone watching, feel free to put any questions in the Q&A or chat on the bottom, and then I'll be reading out all of the questions at the end. So don't be afraid to just ask something as the presentation goes on, and then we'll get to it at the end.
Okay, awesome. Is this better?
Perfect, yes, thank you.
Yeah, sorry about that.
Awesome.
So we can definitely ask any questions that you have in the chat, and if I sound really kind of crackly in the initial part of the presentation, yeah, please ask any questions to address those. But moving along, I want to talk about the solution as well. So the problem, you kind of get a gist of what it is. And this is where you kind of start to wow your investor. Like, how creative can you be to solve a problem like this? So the general gist is what this looks like. You have a very succinct summary of the solution, maybe sounding like your company mission, and a list of few keys and benefits. And in the solutions kind of section, talk about what the product is. I don't think going too much into the demo makes a whole lot of sense, but outlining who's using it, how they're using it, and what are the outcomes is sometimes very helpful. When you're talking to an investor, they're going to dive deep into this question. They're going to ask this question. They might say, hey, well, what more problems does your solution bring about? problems is your solution missing? So outlining that early on and knowing kind of, what your solution is in a pretty kind of explanatory way is very important. So we're going to go through some examples again here. Here's BGIS. Well, it's one sentence. It ties to their problem. Remember, we talked about kind of the project management for content and writing. And it kind of shows you two decks here. I guess two screenshots here that outline what their solution looks like. So you can see a dashboard. You can see, kind of a reporting, and that sometimes solves issues, right? So another example, perhaps not a great example, is Foursquare. Huge company, but did not do a fantastic job with their solution slide. It's too much text. So look here, it outlines the solution a lot here. Foursquare mobile application keeps up with your friends. Current form, Foursquare as a website, to brands and advertisers, to users. There's a lot of things going on here. And what I would do typically is kind of focus a story on one user and the way that they use it, and then the outcomes. So outlining that, I think, is more important in the solution than anything. Mixed panel, pretty good. One sentence. This is typically what you need. Built analytics software for product marketing. Going to continue to penetrate organizations. It's a little bit vague here, but it kind of drives home the point and it connects to the problem. Solution and problem work together, and I think Mixpanel did a okay job here. And let's see Intercom, right? I think Intercom actually did the best job, potentially. They listed their problems, and then, in the slides that would follow this, they kind of talk about maybe a demo, a quick demo screen of what their product looks like. So kind of summarizing, I know I went through this pretty fast, but summarizing kind of what the solution is, it's really something that helps your audience understand how you kind of do things, right? But also explaining where you fit into a problem process. So usually one sentence and a few screenshots is enough for the pitch deck, but just be ready to answer kind of these questions in terms of what your solution does. I think the core part that the solution leads to is the go-to-market strategy. And the go-to-market strategy is something that's always kind of missed, I think, at least when we review entrepreneurs. You have entrepreneurs that come in and say, yeah, we'll just pay Google, or we'll just pay Facebook to kind of use paid ads to make sure that we're getting customers. Well, that's not a very strong go-to-market strategy. And this is where I think differentiates the kind of average story that the entrepreneur tells his investor to a very thoughtful and effective one. So go-to-market strategy, let's take a look at kind of what the overview might look like. In one slide, here's what you need to do. You need to talk about your unfair distribution advantage. So what's your secret sauce in getting out to the audience? Maybe that's your personal network. Maybe that's a very unique way. So maybe an example here is Airbnb using Craigslist as its go-to-market strategy in order to reach customers. And know the differences between kind of this initial user acquisition strategy and these initial partners versus what's next, right? So your initial strategy, you should be really outlining this in the go-to-market here. What data can you actually share based on testing of your kind of user acquisition? Maybe you can say, yeah, I used Facebook, paid marketing didn't work. You can't tell the investor, yeah, organic marketing kind of worked, and here's why. I think really knowing the answers to those questions, you're not going to know the answer to everything, obviously, but be able to answer these problems thoughtfully, I think, is very important. Those initial partners and those initial customers are interesting to talk about as well. And those are the low-hanging fruit, right? Those are the easiest people to get. And who are they? Tell us that. I think that's like one of the really core things here. Here's how you should outline, maybe the go-to-market strategy in a more graphical form. So you have a few different things that are launching. Maybe that's a web iOS app. There are launch dates, there are traction dates, and there are growth dates. And there are going to be different things that kind of are tasks and results. And outlining this to an investor tells them, what to do, and this could work. And, kind of thinking about this in a scientific way, and what needs to be tested, what are some kind of inputs and outputs. I think it's a very prudent, at least, way to talk about the go-to-market strategy. I want to go through a few examples as well here. So here's BGET's go-to-market strategy. All right, we're created through targeted content marketing and press. So basically saying we use paid advertising, but here's what they did well. They combined, so they talked about these numbers, 3.4 million hits. They're on 4 different, kind of press, early press, and, it's working. And they supplement with this slide that kind of breaks down how their go-to-market strategy works. So all content teams, they qualify 2,000 prospects, they engage 442. You kind of go down that funnel. And here's kind of how you explain, what that initial go-to-market strategy looks like. Sales cycle, talk about that, and lifetime value, I think it's good to talk about here as well. Sometimes you might not know, and that's okay. And it's just kind of having an idea of kind of what this industry looks like and how long they might last. And that can be, kind of determined by your product or your feature. So this is kind of a good example. Here's not a very good example. This is actually not Square's actual deck. It's actually a student team that put together the go-to-market strategy for Square. There's a lot going on here. Okay, simple pricing. So that leads to 0 friction. That leads to a free iPhone. Okay. You can see there's not kind of a lot of proof points here or data to support that this works. So kind of avoid using a lot of text and creating these process graphs that don't necessarily lead to another, right? Huge market opportunity in mobile payments, and that inspires the management team, which inspires a solid business model. It's from an investor standpoint, it's hard to tell what's going on here. Let's go through another example. Here is mixed panel once again. Pretty good, not the greatest, because it's it's just a bunch of kind of what we're going to do. The go-to-market strategy is not really outlined here. It's more kind of an expansion plan and what's next type of deal. But I think this is also kind of a good example. Don't mix up your go-to-market strategy with what's next. Focus on what's being done today and what tests are being done. So that kind of leads me to the next really interesting point here: traction. Traction at an early stage startup, you're not going to have any, most likely. But there are ways to talk to an investor about maybe what you have done, right, in terms of customer discovery and what's upcoming. So here's how it should typically look. We understand that there won't be a ton of traction. But if you can convey a few data points to show that there are some early hints at success, then do it. But I really do want to caution, I think, entrepreneurs here, in that when you initially start off, you could have like maybe a contract. Now, let's say you're B2B. Maybe you have a contract. You have a kind of a customized solution building if you're a tech company. We don't see that as traction unless there's a way to show kind of how this scales. Like, are you able to kind of repeat this process over and over again? And that's what kind of goes into the kind of the venture philosophy, right? We want that 0.4% to go 50, 100 times, 1,000 times. And we're okay with 60% of startups not doing well. We want to see that kind of de-risking towards that scalability. Here's Intercom's traction slide. Okay, we're ready for beta. You know, it's not a lot of numbers on here, right? They show a tweet, you know, fantastic idea. But sometimes this might be all you have. Private beta, so they mention here the private beta lovers love the product. Many are psyched to try it. Use numbers. You know, tell us how many beta users. Tell me their session duration. Tell me, you know, like, are they active like how you want them to be active? And note that, you know, daily active users, monthly active users very much depends on your product. No one's going to use Airbnb like daily because no one's planning trips daily. So, so being able to express that in a way here as well to show traction. Here is mixed panel. They actually have revenue. They show your growth rate. Pretty standard. This looks good to kind of anybody. But what I'll note here is that it's easy to be misleading. You kind of see this as a like a linear growth. You didn't note that. I think it makes perfect sense for linear growth, maybe in like a monthly recurring revenue, at least for this company at this stage. But at the early stage, the traction you want to show is like an initial burst of potentially, if it's B2C, usage, if it's B2B, kind of that big funnel, right, of potential customers. So this kind of takes me to the market. So the traction kind of leads the investors down a path to, you know, how big can you get potentially? Here's where I see a lot of problems. Here's what you should do. You want to have a top-down and a bottoms-up approach. You don't have to show this in a slide deck necessarily, but please kind of know where you're getting your numbers. Don't say, I just went on iThisWorld and found a number that said my market was 60 billion. Well, that's probably wrong. And it doesn't show a lot of thought going into potentially how big you can get. This works directly with your business model. So, so thinking about that and how that might work kind of informs your market. Here's a good example. BGET once again. Okay, so we know the high-level marketing software spend will grow by 32 billion. Wow, that's a lot. But we can only serve 1.3 billion of that space. And then they break that down. Why is it 1.3 billion? Because they're going after business content departments, and that's 985 billion. Ideally, you'll be able to answer how that number came about and how any of these numbers came about. But you know, this is a pretty good example of how big the market can be, and it kind of breaks down where you're going, right? So business content departments, SEO, you're going after web PR, creative firms. Here's not a great example. I would say market is big. Well, what market's big? I'm not sure. $5 billion total spend. Who's spending? $1.5 billion discovery and promotion. What's going on here? So this is a company called Soundwaves, and they were focused on music analytics, but branching out into kind of this artist discovery, right, and promotion, event promotion. And what I see very often is something like this. Don't do this. 500 billion TAM, $5 billion SAM, 50 million SOM. Doesn't mean anything to me. Don't use TAM, don't use SAM, don't use SOM. Tell me where you're actually going. I think in a class maybe you can use this, but in reality, it's not everybody's going to kind of understand what this means. And also, I want to note, 500 billion and 5 billion. This is not to scale. And when you put these circles within each other, you kind of feel like, oh, well, if this is 500 billion, then this is 250 billion. You see entrepreneurs, at least we see entrepreneurs kind of do this a lot, not to scale and misleading data. So try not to do this. Don't use circles. Actually, like, tell me what the market is. So here's a pretty good example, pretty easy. SaaS providers take 21 billion, 96 billion in 2016. So this occurred earlier. And then, they're going after mobile and desktop app providers. And my hope is I can just ask the team who their initial market is, and they'll be able to answer it. But kind of knowing what that is, I guess, like the back of your hand, I think that's where, where you need to be in terms of the market. So what comes with market comes competition. And there's no startup without competition. I want to drive this home. There's no startup without competition. Even Airbnb had competition. They all did. But these competition might not have been strong, but they were still competition. And what you need to do here, this is just an example. Some venture capitalists hate XY plans. Some like them. It's up to you on how you want to visualize it in the most clear way. So yeah, you're stronger than them and, the best differentiators. You're not as strong, in these cases. Being honest here is important. And I want to say, going back to, what I talked about before, when you're talking to a VC is invested in you not in the form of debt, but most likely in the form of equity. They don't want you to fail. They actually want this to be a very long-term relationship where they can cash in for 50 to 1,000 times, your current valuation. So be honest, right? Who are you threatened by, actually? What are you missing in your feature set? Here's an example that's not too good. Buffer is the company here. I have no clue what Buffer does, given this slide. You're competing with Google, you're competing with Twitter, you're adding yourself to a sharing platform. Very unclear who your competition is. It kind of puts into question even, like whether I would be able to figure out who your competition is. So I want to provide, don't say we don't have any competition, which is the opposite, right? This is too much competition. We don't have any competition. So you kind of want to be in between that and don't be either. So here's a good one. Once again, BGET, take a look. So content creation, project management, BGET does both. But when you're putting these value adds here, what I see a lot from entrepreneurs is that they like to kind of just put like features down. And they're going to say, we have this feature, they don't. So we're better. But you have to know the value proposition for each feature. And if I ask you like, so why is this feature something that people care about? You should have an answer to that. I think knowing the stats here, knowing the tests that you've done to kind of show the value proposition for each one of these features that, let's say, you have a competitive advantage over, is very important. And especially in startups that are contesting in incumbent markets. So let's say you're a search engine that's competing with Google. Well, you better tell me like how many Google users switched over to you, because the market is so dominated and so saturated, and there's so much barriers to entry. If you can show that you can hit an existing market and change it, having data to show that, I think, is really important in the competition kind of area. Here's one by Mixpanel. So they did the kind of the XY axis here. You have incumbents, you have startup, and it doesn't tell me too much about why Mixpanel is better. So can add a little more to this. Just maybe the team, I'm sure the team had answers. Just want to make sure that you have the answers as well. Here is the one for Intercom. Pretty good. I think unfortunately, a lot of competition, it seems like, and I'm not sure exactly where Intercom kind of fits in. So yeah, kind of using this, but knowing the answers to these questions. And finally, talking about the team. I think honestly, to an early stage investor, the two most important parts are the market and the team. Is the market big enough, and are you capable of getting to that market? I think those are the two core questions that any early stage or pre-seed, seed stage investor is going to worry about. They're not going to worry about financial models as much. They're not going to worry about your business model as much, because it's going to pivot moving forward. But you want to see that scalability, right? So that's why the market matters. That's why the team matters. Team, pretty easy. I'm not going to go into too much detail here. Don't overinflate your ego and put a giant photo of yourself and saying, yeah, like I am the best entrepreneur ever. Maybe you are, but just providing information here. What have you done? Do you have any management experience? How does your team work together? We just want kind of a general sense. Are you scrappy? But keep it brief. Okay, yeah. Investors are going to look for these things, but I'm not going to touch too much into these. Once again, business model, financial projections, use of funds, I think is pretty important. For us, since we're a milestone-based venture capital, we care about what you're going to use the money for. Like, is it going to get you to the next level of potential financing? Are you going for, a Series A, right? Well, do those funds get you there? Will you need to raise additional funding? And I think being clear on that is important. Appendix is kind of where you put all of your data. Just know that, just auxiliary information that you should know and have. But I won't go in depth into any of these. So here's some nice to haves I want to talk about. This is really great. Uber told their investors in this slide deck what are some potential outcomes for the company. So best case scenario, which happened, good for them. Maybe a success scenario, they get a 5%, 20, 30 million a year in profit. That's already a $100 million business, likely. Great job. That's what they hope to happen. I'll stay on the optimistic side, but don't be kind of way too optimistic, right? So the worst case scenario, they just kind of be this, small business. And being honest on this is good. Investors care about outcomes. If you don't do this, they're going to do it anyways. So if you want to kind of support in their process, while they're evaluating you, I think that's really a good thing to talk about. Here's what kind of kills most of, completing that, I kind of want to finish, what's kind of a discussion on what not to say and what kind of leads most deals to not work out, right? Why we won't potentially invest in a company. First one, tough market. And by that, going back to what I said on the market, you can have a large market, but if you can't capture any of it, where there's large incumbents, or it's very hard to even kind of have any traction because the existing solutions are so good, an early stage investor is not likely to support an experienced team. And so I'll provide some examples of what kind of an inexperienced team might do. So let's say they actually don't have a term sheet or commitments from any investors. So they tell other investors that, yeah, they're in, so you should come in too. Never assume. I know people like to hear what they want to hear, and that's just the fact of things. I like to hear what's good for me. I don't like to hear the objective. So just kind of, it's okay if you're inexperienced, but just know that you should be thoughtful. You should not be overly confident in what is out there, because no one has the answers to everything. But you as the entrepreneur are the expert, and you can tell us what you know and what you don't know. And I think that's really a sign of maturity. Non-disclosed risks. Yeah, so there's some skeletons in the closet sometimes. You should tell us that. If you don't tell us, while we're evaluating, we're going to be in some not very, great times right after the investment, because, maybe let's say you have a huge debt, you took on a huge debt, and you're going to use kind of the investor's equity money to pay off the debt. That's a huge risk on the investor's part. We want to use the money to get you to that milestone, not to pay off debts, right? So disclosing that might prevent you from being able to raise a round. So that's why I said know your audience, because VCs are going to dig and they're going to try to figure these things out anyways. Over negotiation and poor negotiation Those are just kind of things that to be mindful of. If you have, let's say you really think highly of your company, and I'll talk about this a little bit more, and you value it at, let's say $20 million before you ever earn a cent of revenue, and you go to investors saying like, yeah, we're raising a price round at $1 million, and we're going to have a $20 million pre-money evaluation. Well, sounds good, but here's the problem. A 20 million evaluation has a kind of an expectation in the market. So if you're saying that you're worth $20 million now when you haven't met that expectation, it's going to be incredibly difficult for you to hit the milestones necessary to raise at that valuation again. So let's say you're going to Series A and you tell them, yeah, we had a pre-money of 20 million in our first round. These people are gonna look for the things indicative of a Series A company. They're gonna be like, oh, did you reach, $1 million in revenue? Well, if you didn't, then we're doing a down round. So your valuation, which used to be 20 million, now becomes 10 million, maybe even less. And that's kind of a big loss, on your end in terms of when you think about equity, even if that round comes together, right? So, know that, know the control provisions. If you're going down the venture path, you're most likely going to be giving up more and more control of your company. You won't be able to own everything, especially if you raise more subsequent rounds. And then financing hurdles, very vague, but that has to do with kind of, are there things, that don't work out in the deal, like maybe some problems with the amount, maybe that's some problems with the way that the deal is done, etc. So that's typically what leads to most deals kind of dying off. Don't say this, once again, I said this earlier, investors are all lined up. Well, VCs talk to each other. Know that for a fact, because I can call the next investor, maybe down the street. I'm like, hey, I heard that you're committed to this company. Is that the case? If they say no, and you told me that they are committed, then that's not a great look on your end. We will talk to each other. The only time when you should say investors are all lined up is if you actually do have a term sheet on the table. And then you can come to me and say, yeah, here's our term sheet. I'm ready to sign it. Are you willing to give a better offer? And sometimes investors are going to put no shop agreements in their term sheets, which means you won't be able to do that if you, let's say, sign a term sheet and go out and try again. So there's often time limit on when you want to get a deal done. But those are good problems to have. So you want to have multiple term sheets because that makes you very competitive. So yeah, I guess I'll pause there and really address any questions the audience has. I know Olivia, I think I saw a few come into the chat. I wasn't able to look at them, but yeah, happy to answer.
Yeah, okay, so our first question, as a VC, how integrated would you like to be a part of the process?
So I'm going to assume the process means due diligence, or if you could clarify that, that would be helpful. But I guess I'll talk about, the due diligence process. So this is the point where venture capitalists are going to work with you, pretty hands-on. We're gonna kind of dive in. We're gonna dig in. We're gonna ask you questions and figure out what's going on, right, with your company. And so that's hands-on. But if we're talking about I see. So day-to-day startup growth connections, right? So that's going to depend on the investor. Let's say you have an angel investor very early on, and that person has worked in the industry that you've worked with before. They could potentially take on an advisory role in which they're actually supporting your day-to-day startup functions, growth, connections, new markets. we at Invest at Detroit Ventures will do that for companies that need it, right? So after we make an investment, if they do need that help in terms of operations and connections, we will offer that to them as a part of our team. Because in the end, at this point, nurturing our investment is important. But if the question is if an investor hasn't made an investment yet, are they involved in this process? The answer is no. There's a lot of startups that these investors are probably involved in. So until they make that investment, I would say this is not something that that an investor would do typically.
Great, thank you. And then our next question, as a hardware product, are investors more wary to invest in them versus SaaS? Yeah,
that's a good question. So if you look, so you're right in that when we think about like an agnostic large-scale investor, right? If you think like a Sequoia or Andreessen, at that point they don't really care. But for early stage, they might. So at the earliest stages, for us, we are industry agnostic. So we look at hardware, we look at all different types of industries, but some might not. So some are very specific investment theses for what they want to get involved in. So there's hardware specific funds that focus on hardware. There's SaaS specific funds that focus on SaaS. So it really depends on the firm, and you will have to kind of dig into maybe their deals to kind of know the answer to that. And I think a good way to potentially do it is look through their portfolio on the website. And if you're in touch with that investor and they're going through due diligence, ask if you can speak with one of their portfolio companies. Just say like, hey, love to chat with XYZ company to learn more about how you are as an investor, because it's a two-way street, right? You want to find the right investor for you, and the investor wants to find the right investment for them. So do that, I think. And to specifically, to be more specific on your question, it really depends on the firm. But there is a tendency to go for SaaS. I think there's a tendency for agnostic funds to go more towards SaaS because of it's less capital intensive. But if you can show a viable path in which a VC's capital can take your hardware to the next level, then I don't think that's a deal that anyone's going to kind of pass up on. So it's about how you kind of present, but also showing that there's a viable path to venture scale.
Gotcha. And then next question, are publication with TechCrunch, Android Authority, etc., are those examples of traction?
Yeah, I would say so. I think especially if you're, a product that has some type of virality or can grow based on those press releases. I showed earlier, for BGET, they had, let's say, like the press, right? Coming in to show their kind of traction, right? So they're featured on Product Hunt, they're featured on, Beta List. I think showing that's fair as long as it's contributing to users and impressions. And so the usual answer is yes, you do want to get featured on TechCrunch if you're a tech product, because more people are going to look at you, they're going to tell their friends, and there is a certain virality to that.
Cool. And then in your slide deck, should there be an ask slide when you're early on in your startup, asking X much for X equity?
Yeah, I wouldn't say X much for X equity, because the deal has not been worked out and there's still some negotiation to do on that end. What I would recommend is talk about your use of funds. So let's go over here. So the use of funds, basically you're going to say, yeah, we're currently raising, $500,000 to do X, Y, and Z. That's how I would typically approach it. And then you can discuss in your slide deck, that's what you have, but in the back of your mind, you should have an idea of, what you want the terms of the deal to be. So typically, I think in the earliest stages, we don't see companies raising a priced round that has a valuation. So there's no kind of translation to like a percentage of your company. But that's a discussion that you should have with your investor, right? So you can talk about, hey, trying to raise, 600, currently thinking that we could do a price round and the pre-money is X. What are your thoughts? And assuming that you're talking to multiple investors, you're going to get kind of like different answers to that question. And so that's when you kind of get an idea of what the market is, what the market's like. And yeah, and you'll see some extremities and outliers, and you could have very predatory investors. So watch out for that. But this is something that I guess happens, as you work through their due diligence process for the investment.
Gotcha, thank you. Next question, have you ever had a startup have larger than expected expenses and come back and ask for more? Did it hurt their credibility?
Absolutely, and it happens a lot. and I don't think it hurts their credibility most of the time. If it's like completely like out of the ballpark in terms of like, I guess when we were doing due diligence and they told us they expect this was their kind of burn, this was how much money they're spending, but it ends up being maybe 10 to 20 times that. And yeah, I think that's kind of a red flag. But let's say, maybe certain product milestones were delayed, right? Let's say COVID hit and some of the manufacturing, let's say your hardware, some of the manufacturing stopped. That's a perfectly valid reason to kind of seek additional funding and, not being able to estimate kind of the future. And you see companies raising kind of these bridge rounds, which are, kind of in between rounds a lot of times. And sometimes they raise not even because they necessarily need the money, but maybe they could use this money to achieve, certain critical milestones that could improve the business even further. So it's not a surprise if a company, comes back and, seeks more money, as long as it's within reason, and not kind of, just kind of a big outlier, right, to what we had expected.
Yes. Okay, next question. What is the best way to get in contact with a firm? Partners, or can you contact through the Contact Us webpage, or are there better ways to do this?
Yeah. If you can get a hold of people's emails, I think a cold email is fine. Like, I think investors are happy to answer a cold email as long as they're like nicely written, as long as they're not like overly salesy, and clearly they're thinking that, I've did some research on your firm, and here's why, like, I'm cold emailing you. Like, let me know if you're interested. Worst case, they're just not going to respond. But know who you're emailing. If you're emailing the managing director or like the partner of a venture firm, they can respond. They might respond. Maybe they will respond, but it depends on the day. I'll be honest. So maybe they're super busy one day and they're going through their emails. They can miss it. If you send it to, like maybe a principal level or like an associate at a firm, I think they're more likely to provide you with a response. So yeah, there are better ways to go other than the Contact Us page. And cold emails do work. Sometimes a LinkedIn, you can just shoot them a LinkedIn request. At least I've talked with startups that way. So a lot of different channels. If you could get a hold of their email, send them a cold email. And know who's in the venture capital firm. Obviously, this industry, people like say, oh, the warm introduction is what's needed. But a lot of the times, if you write a nice email that's, kind of goes over, why you're contacting this person and it's like thoughtful, then I think there's a non-negligible chance that people are going to respond.
Nice. And kind of piggybacking off of that, what is the best strategy for entrepreneurs to get a meeting with an investor?
Yeah. Yeah. So I think this might be like kind of at least this is from my experience. You know, let's say you get on a call and they say no, or you send them an email and they say no. That's not a real no necessarily. So unless they explicitly say don't contact us again, it typically means that you can really have traction, build some progress, and send these investors maybe something else again. So that could lead to a meeting. Sometimes depending on the structure of the firm, sometimes the more junior members, I consider myself a junior member, they can fight for you, right? So if you stay in touch with someone like that, and really dive into and have clarity around this venture scale and everything that I talked about today, like you could potentially that person can fight for you to get a meeting with the managing directors, and I think that's true across the board. So yeah, to answer your question, to get a meeting, just be persistent, but don't be kind of like clingy. I think that's the way. If they tell you, yeah, like come back later, they typically mean they want to see something more before you come back.
Gotcha. Well, that is all the questions we have for you today. If anyone else has any more, I'll give you guys a minute. You can put them in the Q&A section on the bottom or the chat. Up to you. But I do have a question myself. When you talked about kind of like a don't say the inexperienced team part, if you are like just starting out, how do you create what appears to be kind of experienced professional team? Like where do you go about finding these people?
Yeah, and you don't, once again, you don't have to be like, yeah, you can be inexperienced, but if you just don't know the answers, right, to anything that the investor is asking, then that kind of shows your inexperience, right? But I think a good way, so you don't have to have like a professional team to go talk to an investor. Like you could just tell, but if the investor is asking you some questions, right, about like your company, you might not know all the answers, and that's okay. But instead saying, I don't know the answer to that, but here are steps that I'm going to take to figure out the answer. I think that's like a good, like mature way to approach that question. So yeah, no, you don't need like a team that's like 2 times like startup founders or like coming out of, like a high growth startup, a product management, a high growth startup to kind of, go to an investor. Just be confident, but also know what you don't know and be able to tell that to the investor, and they're more likely to help you. And I think for like the very early stage investors like us, like if we see a promising entrepreneur, we're going to help them along the way. It's not going to be a one-time type of interaction.
Gotcha. Perfect. So we do have one more question. What are some clear advantages to Detroit for startups?
So clear advantage to be based in Detroit?
Yes, I think that's what they're asking.
Well, there's a lot of reasons to be based in Detroit, and I can say that for Michigan as a whole. So when we think about like early ecosystems, Detroit is certainly one of those. And a reason why Detroit might be a good place is the cost of living is so low, and startups aren't generating like large volumes of cash initially, and so a lot of people have part-time or full-time jobs. But because the cost of living is much lower, actually enables I guess people to start a company easier. There are great co-working spaces in Detroit that you could take advantage of. There's a kind of a small community, like around like entrepreneurship, right? So reaching out to those folks, people are more willing to help out. What you'll notice in the West Coast is that it's slightly different, and it depends on what you're looking for, right? If you're looking to compete in a very big pond, and you think that you can get out on top, then yeah, go ahead, start a company in San Francisco. You could come out on top, and the top deals are always the most competitive ones. So you can have Coast, Low Sequoia, and everybody writing a term sheet, but the chances of that happening is very low, very low. So for choosing like a more emerging community like Detroit, what you have is actually a more supportive and collaborative even venture community that's willing to help you out, talk through deals, kind of get you started. So I think that's where the differentiator is, and that's why I'm a proponent of kind of the Detroit startup ecosystem, because the folks are great people and it's very collaborative rather than competitive.
Yeah, I've actually heard that from a lot of people, that Detroit is a great incubator for young entrepreneurs. Very collaborative, and everyone's willing to help, which is amazing.
Yeah, and you can raise money outside afterwards. It's not that's not out of the books, right? You can start out here, get your initial traction, especially as products become more remote as well. So it's I personally think it's a sound strategy, and the Midwest is kind of the next area of opportunity for larger and larger tech companies, and just high growth companies in general. Tech.
Yeah, it should be a very exciting future. All right, well, that is all the questions we have for you today. Thank you so much for your time, all your advice and tips. This was extremely helpful to me, and I know everyone who's going to watch this recording and is watching today. So yes, thank you so much. I don't know if Koya has some finishing remarks. Not sure.
I'm all good. Yeah, thank you so much for being here, Zhao. I really appreciate you being able to attend the event. And, I hope that everybody here learned something today.
Yeah, absolutely. And yeah, feel free to contact me. My email is zm@investdetroit.com. So I added to the slides, but I won't add it to the chat. Yeah, feel free to email me if you have any questions. Add me on LinkedIn. However, happy to be helpful. So really appreciate everybody tuning in today, and and thank you, Olivia. Thank you, Korea, for moderating this.
Yes, thank you so much. And I have one last request. I was wondering if we could take a Zoom selfie, if that's okay with you.
Sure. Yeah.
All right, are you ready? Okay, 1, 2, 3. Perfect, thank you.
Yeah. Well, all right.
All right,
thank you
great
both.
talking to you.
Yep. Thanks, everybody. Have a good one. Bye.